We know real estate investing is a long-term game. We always get told it's time in the market versus timing the market. So let's go through some statistics around why real estate performs so well over the long term and why, despite high inflation or low inflationary times, you can still win with real estate. If you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, if you're interested in how to get started with real estate investing, there's a free ebook which I'm going to link in the description below. So go and download it, enjoy life, and read a little bit. Now let's go through a couple of charts that illustrate why real estate investing is so phenomenal over the long term. When owning a property, it can be easy to focus on the short-term changes in value and forget that over many years of ownership, prices are likely to rise. House prices have fluctuated wildly over the past few years, with values in most cities staging a surprise recovery last year after interest rate rises triggered a downturn in 2022. But price growth has slowed over the past few months compared to what was experienced in mid-2023. Okay, so we know that we've come through some really volatile times, and a lot of you guys have started watching the channel in 2020, because that's when I started the channel. So since the start of this channel, all we've had is extreme volatility to the upside and downside when it comes to real estate. And so now, anyone that's really been investing over the last couple of years think this is normal, where you can go and buy a property, 6 months later, it's grown by a lot, and then I can use the equity to go and repeat the whole process, and everything I buy always goes up. And for the veterans out there that have bought and sold property over the longer period of time, we know that's not true. In fact, with volatility, a lot of people are starting to move out of real estate because they don't like it. They're like, hey, I don't want to hold an asset that goes down by 10% one year, but then goes up again by 10% the following year. That volatility is not why people come into real estate. And for those people, I recommend crypto because the volatility there will make you age so much older. Believe it or not, I'm 14, but I invest in crypto.
And that's why I look like this.
But jokes aside, real estate investing is definitely the long game. And the long game is often referred to as compounding growth, because the compounding growth factor that you get after year 5, year 10, year 15, it just keeps getting bigger, bigger, and bigger. Imagine going back to someone in Sydney that bought a house for say $100,000 in the early 1990s, which by the way was like 30 years ago. And you said to them, hey, you know your property that you just bought for 100K, yeah, you know what? It's going to be worth about $2 million in about 30 years time. That person would have said, yeah, cool story. Now we're in 2024 and we can see property prices are a lot higher than that. Not everything will grow in a linear fashion, and that is also the beauty of investing. Because if it was so easy and everyone could just put their money into this account and it just kept going up, then you would say, well, anyone could do it and then everyone would be rich. But if everyone's rich and no one's poor, then how do you know you're rich? Now here's the PropTrack Home Price Index, January 2024. That's the latest data we have. And what we want to focus on is a couple of things with regards to the change from peak and the change since March 2020, which we know is the pandemic. So we're looking at all dwellings. So this is considering units and houses. This number would be much higher if you're looking at just houses. And what you can see is that Sydney is down 0.25% from its peak, so pretty much at all-time highs now, with a median value of 1.057 million. Since 2020, which was only 4 years ago, it's gone up by 31%. This is the most expensive market in all of Australia, and it went up by 31% over 4 years, which when you annualize is closer to our 8% capital growth. You look at Melbourne, which is down by 4.71%, and then you have Brisbane, which is at the peak, along with Perth, and then Adelaide is slightly off its all-time high. We've got Hobart off by 8%, Darwin down by about 2%, and then ACT down about 6%, with the overall capital city market being about minus 0.14%, and the average is about 31.7% growth, which again, annualized is about 8%, and the median value being 823,000. Now this doesn't tell the complete picture, because we also know that there's suburbs within these states that have performed so much better than this average, and then there's others that are lagging behind. We also know that all units aren't created equally, so if you found a cookie cutter apartment that had really no uniqueness to it, it probably hasn't grown that much. Whereas if you've got something that's water facing, that's grown a lot more than even some of the houses that are in some of these suburbs. Now the three main ones that I want to focus on in capital cities is Brisbane, Adelaide and Perth. We've seen 57.8% growth, 58.7% growth, and 50.2% worth of growth since March 2020, which when annualized is greater than 15% every single year. When we come down to the regional areas, we can see that regional South Australia, Western Australia, and regional areas in general are at the peak pricing. What's letting down this number is really what's happening in Victoria and what's happening in Northern Territory. And you'll notice that with Victoria and with Melbourne, you've seen large declines, and that's mainly because of the policies that the state actually has. And this is the number one point why you need to diversify. The amount of people I speak to that have bought property in a certain state or a certain suburb and say, hey, I've done it once, it's performed really well, let me go and do it again. Yes, okay, the theory behind that makes a lot of sense. But what happens if you bought 2 properties in regional Victoria or in Victoria in general? You now would be disadvantaged in the short term. Now, long term, it probably works out, but in the short term, you're not taking advantage of better markets out there. If you had simply diversified and said, okay, I've got 1 property in Victoria, my next one should be in Queensland or it should be in Perth, then your annualized rate of return on your entire portfolio would be a lot better. When you look at the regionals, they're up 50.8% across the board since March 2020. Again, close to that 15% every single year. And what's largely driving this down is the market in Northern Territory. So when you actually look at it, you've got markets in Queensland, South Australia, all closer to about 60%, which is about 15% growth every year. Now you may be looking at these numbers and thinking, that's not that scary. And others might be looking and going, oh my God. I'm sort of in the middle because this doesn't give you the full picture again. Within some suburbs, we've actually seen greater than 100% worth of growth, and not just since 4 years ago, in the last couple of years, which is insane when you think about it, because real estate investing is about the long game. And so if you got 5 to 7% capital growth on leverage returns, you would be so happy. I know for me, when I was looking at my portfolio, I was tracking at about 10 to 11% growth every single year. And then what happens is the pandemic, and the entire portfolio accelerated in growth and moved faster than I thought it would in the following 10 years, let alone in the next 2 years. Now that doesn't mean that anyone that owned assets during that time just significantly became wealthier. Yes, they became slightly wealthier, but the dollar in which it's denominated in has just lost so much of its value. We see memes everywhere saying the money printer go brrr, like everyone's just printing money. Central banks around the globe are creating liquidity, and that liquidity just fell its way straight into assets, which is why we saw cryptocurrency go all-time highs, we saw property prices go through the roof, and we also saw the share market hit all-time highs. So the question is often raised, now that we've had such volatility, are we going to swing to one end and then swing way back to the other and then have shorter cycles, where we could see, instead of 10 or 12-year cycles, seeing close in line with business cycles, we may see smaller cycles like 4 years to 7 years. Then you have something else that has really gained some popularity over the last couple of years, which is the 18.6 year cycle. And that is based on the land cycles around the world. So when you look at that and you tee it up with where everything's placed, with interest rates most likely cutting in late 2024, early 2025, you're probably looking at some sort of peak in property prices and euphoria around 2026 to 2027. Now, how much of that materializes, I'm not really sure. I honestly think that if you're going to make decisions based on just hypothetical or theory-based cycles, you're often going to get wrecked. Yes, it could provide a great guide, and that's why you need to have the right strategy and the right plan along with emergency funds, because the reality is the market can do what it wants to do. If your suburb gets hit, you're unfortunately going to have to sell your property if you aren't planned properly. Now, home values in Australia have never been higher since 2014, have increased by about 80%, despite 2 short downturns between then and now. And what we can see is that it's never linear. All it does is, yes, it's going to head in a certain direction, but it's never just going to go every single year an average of 5 to 7%, call it a day, and we can relax on a beach. No, we're going to provide some volatility, because why? You need to shake out weak hands before you can build a base to go off further and increase that value. What we can see is home price changes over this time, and what we saw was a dip around that sort of 2018, 2019 period, and that was largely driven by the hangover effects of what APRA did, coming in, changing lending restrictions, and really just, focusing on banks lending and not so clear-cut approach. But then what followed was obviously the pandemic and all that liquidity finding its way into the property market, and what we have is this massive growth in prices. Then we had interest rates increase by such a rapid pace that property prices started to calm down. But now we are recording in that 10-year period 80.1% growth in houses. That means annualized is 8%. Now, when you think about 8%, you're like, okay, that's great, right? But what you need to figure out is 8% in the share market is not 8% in the property market. It is very different. I'm not advocating for one over the other. I think it's just really good to understand the scale at which this happens. So let's say, for instance, you go out there and you've got 100K and you put 100K into the share market. at 8% growth, which is phenomenal, you would go and say, okay, out of that 100K, I've made 8%, which is $8,000 that year. Cool, you're probably gonna put it back in, compound that growth, and just repeat. When it comes to houses, that same 100K's probably bought you an asset worth $450,000. 8% on $450,000 is $36,000 every year, and that's gonna keep compounding. That's almost a 5x return purely on the basis that you can go and leverage that money to go and control a larger asset. That's why when you look at 80%, imagine 80% on leverage debt. If you own $2 million worth of real estate in that time, you would have made $1.6 million over the last 10 years. Now here's a graph showcasing capital cities versus regional areas. In the light blue color, you've got 92.5% worth of growth in the regional areas and then 75.7% growth in the capital cities. Now, I want to pause here because on the channel, often people misinterpret what I say when I say regional areas are going to outgrow capital cities. Now, although the data is true, I don't want you to think that all I do is buy in regional areas. We definitely go and buy in capital cities. I have some properties in my own portfolio along with clients' portfolios where we've purchased in and around capital cities, maybe even 20 to 30 minutes away. What we're looking for is just the right location for our assets to be in high demand, not just in the short term, but long term as well. So when I look at this graph, yes, I am definitely a regional fanboy because of the lower entry barrier. And when you're looking at a rate of return and cash on cash return, this is the best place to be because you want to be picking up assets between sort of 300 and 600K, not picking up assets at 1.5 million, because to go from 1.5 to 3 million is a lot harder to do than to go from 500 to a million. Hopefully that makes sense, and if it does, smash that like button. What we can see here is that a lot of the growth that we've seen in the regional markets have really come, according to this graph, around the pandemic era. But what's more important is the volatility is so much lower when it comes to these regional areas. And what I mean by that is look at what's happened in 2018 to 2019 with the red line. What you saw was a deeper retrace in prices. But when you look at that against what happened with regional areas, you pretty much just went sideways. And now similarly, when we saw interest rates increase, we saw a bigger dip in capital cities. But when you look at that compared to the regional markets, they hardly moved. So over the last 10 years, if someone said, well, blue chip is always going to win, and if you get property that's going to give you high cash flow, nah, it's not going to give you capital growth, you can show them this graph. And this graph clearly shows they would be incorrect. Now again, obviously every market is different. And I started investing around 2013 to 2014. So when I look at this graph, it pretty much reinstates what I've already been thinking and is why my property portfolio continues to grow. Now that's not to say that every other market in regional or rural areas are going to grow at the same pace. In fact, they've probably got some more volatility, and with not enough infrastructure spending going out there, they're probably going to be stagnating in terms of growth anyway. So it's clear to understand why real estate investing is so fruitful over the long term, but it's also coming down to not just picking an area and saying, I hope for the best, but you also got to back that up with research. You've got to do it properly. You can't just go, okay, I really want to buy a property because someone told me to, oh, maybe I should reduce my taxes. If you're investing in real estate just to reduce your taxes, you're doing it all wrong. You're better off going and speaking to an accountant to structure things properly so you earn the money in the right structures and thereby optimizing your tax minimization. But if you're going out there and buying real estate for the pure purpose of building wealth, then you can do really, really well. I hope you guys have enjoyed this video, taken a note or two, and if you have, smash that subscribe button, like the video if you haven't already, and leave me a comment down below. What do you think is going to happen to real estate prices here in Australia over the next 10-year period? So that in 10 years' time, we can come back to this video and say, hey, this is what we thought was going to happen. So 2034, here we come. I'll catch you guys in the next one. Thanks, guys.